Welcome back. By now you're familiar with all the general theoretical information about futures that you need before you start trading. So today we begin with practical aspects. Among the very important trading concepts you've learned so far, we find trend, support, resistance, and the importance to be able to identify those areas. One important aspect of trading is the capacity to understand how these levels of support and resistance are formed and what is going on in the other traders' minds. Why? Because with that knowledge, you may be able to identify those areas of support and resistance and take advantage of that knowledge to take your trading decisions. Remember the bulls and the bears? Well, the price of a futures contract is the result of that battle. The buyer, bulls, buys because he believes that the price is going to go higher. The bear or seller believes that the price is going to go lower, and that is why he sells. In other words, the exchange has nothing to do with the price. Buyers and sellers make those prices with their decisions. In the market, there are always three kinds of players. Those who bought, the bulls, those who sold, the bears, those who have not taken a position because they may be uncertain about the market's direction and are not interested in participating yet. We're going to take a quick look at a very important market theory. I am referring to the Elliot Wave Theory. Elliott discovered that in financial markets, investors have an unconscious impulse to do what the others are doing, and that form patterns. Elliott called the behavior of those patterns waves. The basic pattern is 5 waves up and 3 waves down. I want to analyze these moves from the psychological point of view that forms these patterns. Let's say that the first wave of this structure finishes and now the second wave moves within, let's say, a narrow range. So between the origin of wave 2 right here and the end of the range, there is not a big recognizable trend. Those traders in the first group, the bulls, might want to buy more contracts if the price goes above the number 1. Why? Well, because that would be a sign that we're going to go higher. We're going to have a higher high and an uptrend may be forming. However, they know that in the market nothing is a sure guarantee. So recognizing that prices may go down below the origin of wave 1, they put their stop loss right there to protect themselves against a big loss. So they put the stop right here. And by using a stop loss, they are limiting their potential losses. Now, this is what's going on in the minds of the bulls. But what about the bears? Obviously, they will have the opposite reaction to what is going on in the market at that point. If the prices go above wave 1, they will probably have protective stops right there, where the bulls have their contracts to buy more. The bears will have their protective stops to limit their losses. But they are also thinking that if prices fall below the origin of wave 1, then they will sell additional contracts. Right where the bulls put their protective stops, they will probably add new contracts. So, while all this is going on in the minds of the bulls and the bears, the third group is neutral. They're probably thinking, if the market goes above 1, I'll enter a buy order. If it falls below the origin of 1, I will sell. Now, let's say that this wave structure is going to develop to the upside and the market breaks the high of wave 1 right here. Typically, if wave 2 has been in a sideways trend for a relatively long period of time, there will be many buy orders and buy stops above wave 1, and that will cause the market to to go even higher. But that will not happen in a straight line. That wave 3 will probably also subdivide, and we will have retracements along the way. Why? Because of the psychology of those traders participating in the market. Think about it. Some of those buyers that bought early may be satisfied by now and start taking their profits. So they sell, and that causes the market to dip, albeit momentarily, and that makes that wave 3 subdivide into 5 subwaves, just like the original larger one, and each one of those subwaves will also subdivide into 5 in a fractal fashion. Let's put ourselves in the position of a trader in the first group. When the market took the high of wave 1, many bought more contracts, adding to their positions because they thought the trend was to go up. But the truth of the matter is that not all of them added to their positions. Some wanted to make sure that the market was going to make higher highs and higher lows before they could commit more contracts. So they're waiting for a dip. Perhaps during the first subdivision of wave 3 that we label with a small Roman 2, they are going to buy again. Look what is happening. As some of the early buyers started to sell in order to take profits, and as a result of that, the market started to dip, other traders are precisely waiting for that dip to buy more. Meantime, what happened to the bears? Well, there were some really smart ones that limited their losses buying their contracts backed with a limit stop order above here, wave 1. Remember? Now, did all of them did that? Not all of them, I'm sure. So as they saw the market going against them, they are probably waiting for a dip so they can buy their contracts at a minimum loss. And now that the trend is seemingly established, those traders that were neutral, waiting for the market to commit in one way or another, are now ready to participate and will probably place orders below the market so they can get in on a dip as well. Now let's see what is happening here in the different groups. The first group, the bulls, are waiting for a dip to buy more. The bears are waiting for a dip to buy their contracts back at a minimum loss. And the neutrals are waiting for a dip to start participating in the market. This creates a situation in which at that particular area, all those traders are expecting to buy, and that is how the collective effect of those traders forms an important support area. Remember support? That particular area where most traders believe price will move higher. Now, you know exactly how the support is formed. The three groups involved are increasing buying orders for different reasons. So the market, finding that strong support, rallies again with even more power, producing what is known as the fastest move in the shortest amount of time. That in the Elliot theory is called wave 3, this one that you see here. Now let's get back to the bears that had originally sold during the consolidation period of wave 2. As we discussed, some of them, probably the smartest ones, had their protective stops above wave 1. Others waited for the first possible dip to minimize their losses, and still others stay in the market with the hopes that the market will turn back in their favor while carrying increasing losses. Can you imagine the psychological stage of these people? They are probably full of negative emotions because they are losing so much by now. They are hating themselves. Most start to blame the market, the other traders, the government, etc. So at some point, they start liquidating their positions. Others will even reverse their positions and go long. During this third leg, some of the third neutral group that had not entered the market yet because, well, probably they were too hesitant, or maybe their orders were placed far too low, so they start buying at whatever price the market is trading now because they don't want to miss it. There we also have those original bulls that sold early, you remember, the ones that were satisfied, they may now be kicking themselves, thinking that they are missing out in such a big move, and well, they try to get back in at either a market price or in another dip. And in this fashion, the market produces several waves. The Elliot Wave Theory is not really part of the meditative trader syllabus. However, understanding how the market moves according to the psychology of the participants, resulting in support and resistance areas, is definitely part of understanding the meditative trader. So to summarize our example of how support is formed: 1. Traders with long positions that are adding contracts to their positions. 2. Traders with short positions that are waiting for a dip to buy back their contracts as a minimum loss. 3. New traders without previous position who have the conviction the market will continue establishing an uptrend. And it is this psychological behavior which produces the series of higher highs and higher lows that defined an uptrend. Will that uptrend stay forever? Of course not. At some point, the same psychology that applied to wave 1, remember when satisfied traders started to take profits and that produced a dip in wave 2? Well, the same psychology applies here at the end of wave 5. That is a reason why markets are fractal, and the patterns that Elliot discovered in his theory repeat themselves in different time frames. In other words, the entire psychological cycle that produced 5 waves in a 1-minute chart is now the very first wave in a higher time frame, maybe a 15-minute chart. And when the same cycle completes itself in a 15-minute chart, that may be the building block or the building stuff for the first wave in a daily chart, and so forth and so on. A very important point to keep in mind here is that whatever the area of resistance, one that is penetrated, it becomes support, and vice versa. In other words, if the support is penetrated, then now that same area becomes resistance. It is very important that you remember that. Now today you have homework. You must identify points of support and resistance and mark them in your chart. To do so, you can simply use a chart marker. I will make another video to show you how to do that. Then, using your DOM, place buy orders on those areas of support that you identified and sell orders on the areas of resistance. Make sure to send us your homework for revision. Next on TMT, overbought and oversold.